Hello, I'm Katie St. Ors, certified financial planner, tax strategist, and producer of The Deep Dive. Welcome to Season 3, Episode 30, and today we will do a deep dive into the required minimum distribution. Okay, it looks like Elizabeth and Michael have their coffee filled and are settled in behind the microphones. So let's get going.
Welcome to The Deep Dive. Today we're diving into something super relevant if you're thinking about or are already navigating retirement, required minimum distributions, or RMDs. Now, it might sound a bit like alphabet soup, but, understanding these rules can really save you some serious cash and maybe a lot of future stress.
That's absolutely right. If you've been, diligently saving in those tax-advantaged retirement accounts, these aren't optional suggestions.
Right.
They're mandatory withdrawals Uncle Sam requires you to begin taking at a certain point.
Yeah.
And let's be clear, missing the boat on this can lead to some pretty stiff penalties.
Yeah, you don't want that.
No. So getting a handle on it is key.
Absolutely. So our goal today is to really kind of demystify RMDs for you. We'll explore what they are, pinpoint exactly when you need to start taking them, break down how that withdrawal amount is calculated, and discuss some really smart ways to manage them effectively. Think of this as your shortcut to feeling, totally in control of this crucial aspect of your financial future.
And just to set the stage, RMDs generally apply to those familiar retirement savings vehicles like traditional IRAs, simple IRAs, SEP IRAs.
The usual suspects.
Exactly. And those employer-sponsored plans you might have, such as 401k, 403bs, and other similar defined contribution plans.
Okay.
It's worth noting right off the bat, though, that Roth IRAs have a different rule.
Ah.
Yeah, they're exempt from RMDs during the original owner's lifetime. But Roth 401ks do have these requirements. That's an important distinction.
Okay, good flag. So let's dig a little deeper into the why behind all this. Why does the government even mandate these withdrawals? I mean, it almost feels like they're saying, okay, you've saved enough, now it's time for us to get our cut. Is there a bit more to it than that?
Well, yeah, there's definitely a rationale behind it. Think about it. With those pre-tax retirement accounts like traditional IRAs and 401ks.
Right, the ones where you got a tax break up front.
Exactly. You received a tax deduction when you made the contributions, and your money has been growing tax deferred all this time. So the government essentially wants to ensure that eventually those funds are withdrawn and become subject to income tax. A way for them to eventually recoup the tax benefits they initially provided. It's not purely about getting their cut now, but more about, that initial tax advantage coming full circle.
That makes sense. It's like a deferred tax situation that eventually comes due. Okay. Yeah. So when does this mandatory withdrawal clock actually start ticking? The age seems to have shifted a bit in recent years, hasn't it?
You're absolutely right. It has. The age when RMDs kick in has indeed been adjusted, and it hinges on when you reach certain ages.
Okay.
So if you turn 72 before the year 2023, your first RMD was required by April 1st of the year following the year you turned 72.
Got it. Before 2023, age 72.
Right. Now, if you reach age 73 in 2023 or any year thereafter, the general rule is you'll need to take your first RMD by April 1st of the subsequent year.
So age 73 for folks hitting that mark now or later.
Correct. And looking further down the road, there's another change coming. If you reach age 75 after the year 2032.
Wow. Okay. Planning ahead.
Yeah. The starting age moves to 75, again, with that first RMD deadline being April 1st of the following year. So it really depends on your birth year. Keep track of that.
Okay, so there are a few different age thresholds depending on when you hit those milestones. That's a crucial detail to keep straight. What happens after that initial RMD? Is it just an annual thing moving forward?
Yes, exactly. After you take that first RMD, the deadline for all your subsequent RMDs becomes December 31st of each year. Straightforward enough.
December 31st, okay.
However, and this is a really important point to flag.
Uh-oh. What's the catch?
Well, if you decide to push that first RMD to that April 1st deadline.
Which you're allowed to do.
Right, you are.
Yeah.
But if you do, you'll actually end up having to take 2 RMDs in that same calendar year.
2? How does that work?
You'll have the one for the previous year, the one you delayed until April 1st. And then you'll also have your regular RMD for the current year due by December 31st.
Ah, I see. So you're doubling up in that first year if you delay.
Precisely. And doubling up like that could definitely bump you into a higher tax bracket for that year.
Oof. Yeah, that sounds like a potential tax headache you'd want to steer clear of, if possible, having twice the taxable income from retirement withdrawals in a single year.
Definitely something to think carefully about. Maybe take the first one in the year you actually turn the required age, even though you have until April 1st of the next year.
Good tip. All right, so we've nailed down when RMDs start, but how do you actually figure out how much you're required to take out? Is it just some fixed percentage of your total retirement savings?
Not exactly a set percentage, no. The calculation involves a couple of key steps. It's pretty methodical, actually.
Okay, lay it out for us.
The first thing you need to do is identify the total balance of your retirement account as of December 31st of the previous year.
Okay, previous year and balance, got it.
So for your RMD in, say, 2024, you'd be looking at the value of your account on December 31st, 2023. That's your starting point.
Got it. So it's that year-end statement from the prior year that I need. What's the next piece of the puzzle?
The second step is to determine your applicable life expectancy factor. The IRS provides these factors in what they call tables.
IRS tables, okay.
Yeah. The most commonly used one is the Uniform Lifetime Table. Think of this table as providing a number based on your age.
My current age.
Your age for the year the RMD is due, yes? That number represents the period over which the IRS expects you to draw down your retirement funds, basically.
Okay.
There's also a different, slightly more favorable table you would use, but only if your spouse is more than 10 years younger than you and is your sole beneficiary.
Ah, a specific scenario there. But for most people, it's the Uniform Lifetime Table.
Correct. For most people, that's the one.
Okay, so I find my age in this Uniform Lifetime Table, and it gives me a specific factor, a number. What do I do with that factor in my account balance?
It's a pretty simple calculation from there, actually. You just divide your account balance from that previous December 31st.
The number from step 1.
Right, by the life expectancy factor you found in the IRS table for your age.
Okay.
The result of that division is your required minimum distribution amount for the current year. Balance divided by factor equals RMD.
Could you walk us through a quick example just to really solidify how this works? Numbers always help.
Certainly. Let's imagine our friend Susan. Let's say she's 74 years old this year.
Okay, Susan, age 74.
And she has a traditional IRA with a balance of $400,000 as of December 31st of the previous year.
$400K balance. Got it.
Now, if we look at the IRS Uniform Lifetime Table for age 74, let's say, for the sake of this example, that factor is 25.5.
Okay, factor is 25.5.
To calculate her RMD, Susan would divide her $400,000 balance by 25.5.
Right. Balance divided by factor.
Which works out to approximately $15,686.
$15,686.
Yep, that's the amount Susan would be required to withdraw from her traditional IRA for the year.
Okay, balance divided by this life expectancy factor. That seems straightforward enough for a single account. But what happens when someone, like, many people, has multiple retirement accounts? Does figuring out the RMD get more complicated? Do they have to take a little bit out of each one?
That's a really insightful question, and the rules surrounding this can be a bit nuanced. It depends on the type of retirement accounts we're talking about.
Okay, so it's not one size fits all?
Not at all. For certain kinds of accounts, the IRS actually allows you to aggregate your RMDs.
Aggregate. What does that mean exactly?
What this means is you calculate the required distributions separately for each eligible account you have.
Okay, still calculate for each one.
Yes, but then you have the flexibility to withdraw the total combined amount from just one, or from any combination of those eligible accounts.
Ah, okay. So you add up the individual RMD amounts,
Yeah.
and then you can take that total sum from whichever account or accounts of that type you want.
Precisely. It gives you some useful flexibility.
Which specific types of accounts fall under these aggregation rules? Where do I get that flexibility?
Generally speaking, traditional IRAs, sub-IRAs, and simple IRAs all fall under this umbrella of aggregation.
Okay, so all the different types of IRAs, basically.
Pretty much. So if you happen to have several of these types of IRAs, you would still calculate the RMD for each one individually based on its own balance and the factor.
Right.
But then you add those RMD amounts together, and you have the freedom to take that entire sum from whichever of those IRA accounts you prefer. Or you could spread the withdrawals across them however you see fit.
Nice.
This aggregation rule also extends to inherited IRAs, provided they were all inherited from the same original account holder.
Okay. Good to know for inherited accounts, too. What about 403Bs? You mentioned those earlier.
Yes, 403B plans have their own set of aggregation rules that actually mirror those of IRA.
Oh, interesting. So same flexibility within 403B.
Correct. You calculate the RMD for each 403B you own separately, but you can then withdraw the total required amount from one or more of your 403b accounts.
That sounds like it could definitely simplify things for folks with multiple accounts of those types IRAs or 403bs.
It certainly can.
But I think you hinted earlier that this aggregation, this flexibility, doesn't apply universally to all retirement accounts.
Exactly. That's the crucial part. When we look at 401k, profit-sharing plans, and 457b plans.
Okay, the employer-sponsored ones, often.
Right. For these types of accounts, the rules are different. You cannot aggregate your RMDs across them.
Cannot. Okay, so no lumping together 401k RMDs.
No. Instead, you are required to calculate the RMD for each individual 401k, each individual profit-sharing plan, and each individual 457b account separately.
Calculate separately, same as before.
Yes, but crucially, you must withdraw the required amount from that specific account.
Ah, okay. So if my 401k at Company A needs an RMD of $10,000, I have to take $10,000 out of that 401k.
Precisely. And if your 401k from a previous job, Company B, needs an RMD of $5,000, you have to take $5,000 out of that specific account. No combining.
So no mixing and matching withdrawals between those different types of employer-sponsored plans.
That's correct. And this is a really key distinction to understand. You cannot satisfy a required minimum distribution from one type of retirement account by taking an extra withdrawal from a completely different type of retirement account.
Okay. Explain that further. Give me an example.
Sure. Let's say you have an RMD obligation from your traditional IRA. Say it's $8,000.
Okay.
You also have an RMD obligation from your 401k. Say it's $12,000.
Right.
You cannot fulfill that $8,000 IRA RMD by just taking $20,000 out of your 401k.
Ah, I see. Even though $20,000 covers the total RMD needed across both.
Exactly. It doesn't work that way. The $8,000 IRA RMD must come from an IRA or aggregated across your IRAs.
Okay.
The $12,000 401k RMD must come from that specific 401k. The withdrawals must come from the same type of account, or in the case of 401ks, et cetera, the specific account that the RMD is calculated for.
That makes it really clear. So IRAs and 403bs have this intra-type flexibility, lump them together within their own category. But when it comes to 401ks, profit sharing, and 457bs, they're all in their own separate boxes, and you have to take the RMD from each one individually.
You got it.
This is definitely something important to keep track of if you've got a mix of retirement savings vehicles. Okay, now we've talked about what happens when you do take your RMD. What are the consequences if life gets in the way and you just miss it, or you don't take out enough?
Yeah, that's not a situation you want to find yourself in.
Yeah.
The consequences can be quite significant.
How significant?
The IRS imposes a pretty hefty penalty if you fail to take your required minimum distribution, or if you take out less than the required amount. Currently, that penalty stands at 25%.
25%.
Yes, 25% of the amount that you should have withdrawn but didn't.
Ouch. A 25% penalty sounds like a real sting. That's substantial.
It really is. It used to be 50%, actually, so 25% is better, but still very significant.
Wow. Okay, let's go back to our example with Susan. She needed to withdraw $15,686, right? What would the penalty be if she just completely forgot and took out nothing that year?
If Susan failed to take any RMD in that scenario, the penalty could be $3,921.50.
Nearly $4,000.
Yep, that's 25% applied to the $15,686 she should have taken out. That's a substantial chunk of change just for an oversight.
Absolutely. That's money that could have stayed in her retirement account or been used for living expenses, gone just because of a missed deadline.
Exactly. It underscores the importance of paying close attention to these rules.
So what's the best approach then? How do you make sure you don't fall into this costly trap, especially if you have multiple accounts to track?
Well, one really practical and honestly effective strategy is to set up automatic withdrawals from your retirement accounts to cover your RMDs.
Ah, automation. Good idea.
Yeah, most financial institutions that manage these accounts, custodians like brokerages or banks, offer this service.
How does that work?
You can typically specify the amount you need, either the calculated RMD or have them calculate it, and the frequency, maybe monthly or just one lump sum before year end. Setting this up can really help ensure that you don't miss the December 31st deadline and avoid that significant penalty.
So you basically tell the IRA provider or 401k administrator, hey, make sure my RMD gets paid out automatically before the deadline.
Pretty much. It's all about taking proactive steps to maintain compliance and remove the chance of forgetting.
Definitely sounds like a smart set it and forget it approach to prevent a potentially painful financial hit. Okay, now let's switch gears a bit. We know that RMDs from those pre-tax accounts like traditional IRAs and 401ks are generally taxed as ordinary income, right?
That's correct. They add to your taxable income for the year.
So are there any savvy strategies people can consider to potentially lessen the tax burden of these withdrawals? Or maybe even use them in a more strategic way beyond just taking the cash?
Yes, absolutely. There are several really interesting strategies that individuals can explore, especially if they plan ahead.
Okay, I'm listening. What have you got?
Well, one popular one, particularly for those who might not need the RMD income immediately for living expenses, is to consider Roth conversions.
Roth conversions, we hear a lot about those. How do they help with RMDs?
By strategically converting funds from a traditional IRA or pre-tax 401k to a Roth IRA before you reach your RMD age.
Before the RMDs start kicking in.
Right, crucially, before. By doing that, you can actually reduce the balance in those pre-tax accounts that will be subject to future RMDs.
Because the money moved to the Roth IRA.
Exactly. As we discussed earlier, Roth IRAs don't have those lifetime RMD requirements for the original owner. So less money in the traditional account means smaller future RMDs.
Makes sense. But there's a catch, isn't there? Taxes.
Of course. It's important to remember that you will pay income taxes on the amount you convert in the year of the conversion. So this is something you'd want to carefully evaluate based on your current and projected future tax situation.
So it's a trade-off.
It is. You're essentially paying taxes now, hopefully at a manageable rate, to potentially avoid larger RMDs and the associated taxes later, possibly when you might be in a higher bracket or just prefer tax-free withdrawals from the Roth.
That makes a lot of sense, essentially shifting the tax liability to the present to potentially gain more control and tax-free withdrawals down the road. What other proactive steps can people take?
Another really valuable strategy, especially for individuals who are age 70 and a half or older.
70 and a half. Interesting age.
Yeah, that age is specifically relevant here. If you're 70 and a half or older and have charitable inclinations, you can use qualified charitable distributions, often called QCDs.
QCDs. Okay, how do those work with RMDs?
This allows you to donate money directly from your traditional IRA to a qualified charity. You can donate up to $105,000 annually per person for 2024. That limit is indexed for inflation now.
Okay, donate straight from the IRA.
Yes. And the really beneficial part here is that the amount you donate via a QCD can actually count towards satisfying your RMD for the year.
Oh, wow. So the donation fulfills the RMD requirement.
It can, up to the amount of your RMD. And here's the kicker. That distribution, the QCD amount, isn't included in your taxable income for the year.
So it satisfies the RMD and it's not taxed?
Correct. It's excluded from your gross income. This can be a very tax-efficient way to fulfill your charitable giving goals while simultaneously meeting your RMD obligations. It's a win-win for those who are both required to take RMDs and want to support their favorite causes.
That sounds like a fantastic strategy. You meet the requirement, help a charity, and potentially lower your taxable income compared to taking the RMD as cash and then donating.
Exactly. It avoids the income inclusion altogether for the amount given via QCD.
Great stuff. Are there any other angles people should be considering in terms of managing their RMDs tax-wise or strategically?
Well, just general proactive tax planning around your RMDs as you approach that trigger age is also really crucial. Don't wait until the year they start.
What does that involve?
It's wise to start thinking about how these mandatory withdrawals will factor into your overall income stream in retirement. How will they interact with Social Security, pensions, other income? And importantly, how might they potentially affect your tax bracket?
Right, because it's added income.
Exactly. By planning your withdrawals in advance, you might have some flexibility within the RMD requirements.
Yeah.
Of course, maybe in terms of which assets you draw down first or timing other income sources. This forward-thinking approach could help you manage your taxable income more effectively over time and potentially avoid unexpectedly jumping into a higher tax bracket or triggering higher Medicare premiums, for instance.
Good point about Medicare premiums, too.
Yes, that's definitely part of the planning conversation. And just to reiterate, generally, those RMDs from your pre-tax accounts are taxed as ordinary income at your prevailing income tax rate in the year you receive them. Unless, of course, you use something like a QCD.
So it's really not just about the mechanics of taking the money out. It's about being strategic about how and when you do it, and really considering those powerful tools like Roth conversions before RMD age and QCDs once you're eligible to potentially minimize the tax impact or align with your charitable giving.
You summarized it perfectly.
This has been a truly insightful deep dive into navigating the complexities of RMDs. Really helpful.
Absolutely. And understanding RMDs isn't just about compliance, ticking a box. It's a fundamental part of taking control of your retirement finances.
Right.
Avoiding unnecessary penalties,
Yeah.
which we saw can be quite large, and making informed decisions about how to best manage your retirement income for a secure future.
So just to bring it all together for you, our listener, required minimum distributions, RMDs, they're those mandatory withdrawals from most pre-tax retirement accounts, like your traditional IRAs and 401ks. The starting age depends on when you were born, could be 73 now, moving to 75 later.
Check your birth year.
Right. The amount you're required to take out each year is calculated based on your account balance at the end of the previous year and your life expectancy factor from those IRS tables.
Balance divided by factor. Yep.
And remember those specific rules about aggregating RMDs? You can do it for IRAs and 403Bs amongst themselves,
But not for 401k.
but not for 401ks, profit sharing, or 457Ds. Those have to be taken from each specific account. And definitely remember that significant 25% penalty if you don't take them.
Crucial point. And perhaps most importantly, remember that there are proactive strategies you can explore. Things like Roth conversions done before RMD age,
Get ahead of it.
and qualified charitable distributions, or QCDs, once you're 70 and a half or older. These can offer you ways to manage your RMDs more effectively and potentially reduce their overall tax impact.
Ultimately, navigating the world of RMBs can feel a bit intricate, and everyone's individual financial situation is, of course, unique. It's not simple stuff sometimes.
It really isn't. There are nuances.
That's why we strongly encourage you to consult with a qualified financial advisor or a tax professional, someone who can look at your specific picture.
Yes. They can provide personalized guidance tailored to your specific circumstances, your accounts, your goals.
The IRS website, irs.gov, is also an invaluable resource. You can find detailed information there and those official RMD life expectancy tables we mentioned.
Definitely check irs.gov for the official rules and tables. But personalized advice is key. They can really help you navigate these rules and develop a comprehensive strategy that seamlessly integrates with your broader retirement income plan.
Makes sense. So as you reflect on your own retirement savings journey and the eventual prospect of RMDs, here's a final thought for you to consider. Given the various complexities, deadlines, potential tax implications, and even the strategies like QCDs and Roth conversions we've discussed today, how might proactively planning for your required minimum distributions fit into your overall retirement income strategy? How can you use this knowledge to ensure a more secure and tax-efficient future for yourself?
It's definitely something worth taking some time to think about, maybe even starting that conversation with an advisor sooner rather than later.
Absolutely. Well, thanks for joining us for this deep dive.
It's been a pleasure.
We'll see you next time.
See you later.
Okay, great. That's a wrap. I'm Katie St. Ors, and let me send out a huge thank you for listening. If you want more content on personal finance and small business, head over and find me on YouTube. You can also find me on Spotify, Amazon Music, TikTok, and Apple iTunes. Thanks again for tuning in, and I'll catch you on the next Deep Dive podcast.